Welcome to Investors Insights. Our topic today is Beyond the Market Headlines. We chose that topic because one thing here at Five Plan Partners we like to provide is that while you're hearing things in the news media, we like to look beyond the headlines, look at the data that the market will be looking at down the road, and we want you to know about it. I am joined today with some great information and research on the part of these three gentlemen, Bobby Norman, Trey Booth, and Ty Miller. And I think you're going to find this very beneficial as we look beyond the market headlines. Bobby, I'm going to ask you to start us off because the market had strength this year, but you've got some insight that on concentration, I'm going to use that as a key word, that I think our viewers need to understand.
Yeah, I want to talk about market concentration, which is a topic that rolls over from last year. So 2023 was a historic year in financial markets due to the incredible concentration of stock market gains. So much concentration that 56% of the S&P 500 index performance came from just 7 stocks, the so-called Magnificent Seven, mostly technology-related stocks. They doubled in value during 2023, powering an otherwise basically uninspiring stock market higher. And so these handful of stocks benefited from the perfect storm. Depressed valuations coming into the year, an impressive rebound in earnings, and a craze around artificial intelligence. As you can see in this first chart, the U.S. equity market now enters 2024 with its highest level of concentration since the mid-1970s. Good news is we expect to see the concentration lower in 2024, which would mean the broader participation by more of the stock market. And it also, as you can see in this next chart, only 27% of the S&P 500 stocks beat the index last year. That's the narrowest leadership in almost 40 years. Our belief is that the narrow market experienced over the first 10 months of last year continues to broaden out in 2024 as it did in the last 2 months. And like I mentioned earlier, 2023 was highlighted by the 7 largest, mostly technology-related stocks leading the market. But we believe 2024 will see much broader participation for really 2 reasons. First, valuations are significantly better outside the largest mega cap names in the U.S. market. Second, technology is not the only sector expected to experience strong earnings growth, as sectors such as healthcare, industrials should also grow at above market pace. So our thoughts for 2024 are to stay diversified as there is a wider group of companies that will reward investors in 2024 more than they did in 2023.
No, I thought that was excellent and a very valid point as investors are looking where to go and as we're making recommendations to our clients and diversifying their portfolios in relation to their financial blueprints. Another topic that we have continued to hear about is people talking about interest rates. We've had people say to us, well, I may not refinance or buy that house till next year, take out a loan to finance my business, those kind of things, because I think interest rates are going to go lower. That's been one of the topics out there. Trey, you did an outstanding job this morning explaining some things as to why we may not see that. Talk about that on interest rates. And then you also brought up about international with China and Taiwan as one of the, we'll just call it question mark, mega threats that could possibly happen. So talk about that.
Yeah, absolutely. Thanks, Greg. So the Federal Reserve met in mid-December and gave the market pretty much exactly what it wanted, a kind of a perfect meeting projecting that they are open to cutting rates in the new year. And what happened after that, we got a phenomenal Santa Claus rally that Bobby talked about that was fairly concentrated in the larger companies, but still pushed markets higher as interest rates fell. The market priced in 6 rate cuts in 2024 from the Federal Reserve. So what has to happen for that to occur? So since that meeting, really, we haven't had a lot of news come out. We had with the holidays, a lot of big events kind of get below the headlines. This week we get our first inflation print of 2024, and for there to be 6 rate cuts this year, starting as early as March, we really need to see inflation come down. The last print we got on headline inflation was 3.14%. We really need to see it come lower than that, which would put it nearly into 2s. That's really not what's expected. So the market may get a surprise of just normalized inflation about 3.5%. And that's really not what the market's pricing in. It's going to be hard for the Fed to cut rates if inflation doesn't come down to its level of 2%. And so that's a big news story that everyone knows about, but the market seemed not to be pricing that in as a possibility. Market priced in, all right, inflation's beat, the Fed's cutting rates, we're going to have a soft landing. That's a lot that's priced into the market from the middle of December till today. Then secondly, though, something that's behind the headlines, surprisingly not being talked about, is the Taiwanese election that's being held on the 13th of January. Typically not something we talk about, but China has definitely been more in the headlines with some saber rattling and some strong arguments against the pro-freedom and pro-independence Taiwanese party, which is expected to gain control after this election. It's not really what happens in the election. It's the action. The action's not really the issue. It's the reaction that China has, knowing that on Monday, Martin Luther King Day, our markets will be closed. And so we won't be able to react quickly to any Chinese action over the weekend. So something that bears concern as we go into a long holiday weekend that really isn't being talked about, something that our research groups say is a very important event that we really need to watch closely.
You're absolutely right, Trey, about watching it closely. Also, for our viewers, just talk about the Chinese economy right now because they're hurting.
Well, that's true. We saw that with certain more dictatorial countries when the economy or public unrest starts to rise. There's nothing that cures public unrest like a good old-fashioned conflict. And so we saw it previously, pre-COVID, with Hong Kong when China really started to crack down on Hong Kong after there had been some issues with the Chinese economy prior to that. And then we forget we've reopened. Most of the world has reopened after COVID, but China still is in partial lockdown mode. Their economy really is still not recovered at 2019 levels, not even close. And so there's a lot of unrest and uncertainty around that. And so there's more public saber rattling. The Taiwanese issue has always been kind of behind the scenes in terms of diplomatic relationships between the U.S., China, and Taiwan. They've pushed it really to the front of their newspapers. We're not really covering it here, but it's something of top topic for them. And that's likely, to your point, Greg, due to their economic weakness, they've got to find some sort of scapegoat. And that's kind of concerning.
Yeah, that's what bothers us even more about this situation. And Ty, your data I found really fascinating this morning because here we are talking about these different issues with Bobby and Trey, and you're talking about the consumer and where they are on the optimism level, as well as let's talk a little bit more of China as a trading partner and what may have changed there too. Talk about that.
Yeah, I think I'll, just kind of hammer the nail home here with China. Kind of the first shoe to drop was that Mexico is now our leading trading partner after years of China being our leading trading partner, really since basically 2003, 2004. Mexico has overtaken them, with all of the tariffs and all of the trade restrictions that we have had with China since about 2020. Reshoring and nearshoring have become more popular concepts. And kind of the first shoe to drop here is Mexico surpassed them. It'll be interesting to see what other trade partners, kind of surpass China here, or as Trey mentioned, if they kind of jumpstart, their economy that's been held back for a while, maybe they kind of take it back over. But it's an interesting dynamic to keep an eye on as we move forward. And then on the consumer, we all know that, in 2023, there were a lot of calls for a recession. One of the reasons that didn't happen officially is the consumer was really strong. And so in December, we got the Wallet Hub Economic Index. And really, this chart just measures how finances will look 6 months from now, according to the consumers. And so we're at 12% increase compared to last year in December. Consumers are really bullish about where their finances are going. The same survey showed that most people think that they're going to reduce debt. It's hit the highest level since December 2020. Consumers overall have a lot of optimism, and it just kind of brings to a little bit of concern. Is this as good as it gets for the consumer? And so that's something that we want to take the other side of. Not necessarily saying that it can't get better, but we just want to keep an eye out. A lot of times when everybody knows something or everybody's really confident, the opposite kind of tends to happen. So we want to just be on the lookout for that and be a little cautious with all this optimism out there.
Yeah. So folks, I think this is excellent information, and you need to know we're going to be watching all this closely as we start this new year, 2024. We thank you for believing in us. We thank you for all the comments you're making in regards to our blogs, as well as our social media on Facebook, Twitter, LinkedIn, our podcast on YouTube. We continue to expand on that because of your feedback, as well as you sharing it with others. That's meant a lot to us. And so beyond the market headlines is what we're looking for so that we can see what the rippling effect is of events that are occurring both economically as well as geopolitical and other aspects so that we know how to navigate in relation to your financial blueprint. We're excited about the 2024 year, and we're thrilled that you're with us. And we thank you again so much. We want you to have a great week. We want you to have a healthy, happy, prosperous 2024, and we will keep you informed throughout all of it. Thanks again. Talk soon.